And I think the market was a little bit more spooked by the numbers, certainly than we were. Um, Turnover for the company grew 42% in the last year. Gross went up 66%. The one that everyone's paying attention to, was active clients in the US. That grew a fairly impressive 367%. What spooked the market was a couple of things. One is they're spending a lot of money in that push into North America, as they rightly should, because this is a one-shot deal with that US opportunity, as the legislation has changed, allowing for online gambling. So it really is a land grab. And PBH needs to be in there grabbing that space, because as we know, if you get there first, then you get to occupy it for the rest of the time, provided you provide a good product. So they need to spend that money. They need to push in that space. Otherwise, I'll be having a conversation in 10 years about the one that got away. The other thing that spooked the market a little bit is they have slowed. Their growth rates in the US have slowed, but this was something that the company had talked about, because, again, it is that land grab and there's going to be fierce competition. Pointsbet has a few products being released over the next 6 to 12 months, which will hopefully arrest that slide. But like I said, we just think that 18% share price dump is a little bit short-sighted and a little bit overdone. If you understand the long-term opportunity in the US for Pointsbet, it makes a little bit more sense.
Chris, let's move on to your buy for today. Now, on the trade, we always talk about that perfect mix of fundamentals and technicals. Now, I know for your pick, it's looking pretty technically strong. So tell us what it is and why it marries up with those fundamentals.
Certainly, Cara, it's computer share, and yeah, it has just broken out or broken to levels not seen since 2018. So as you know, I love my technicals. So that's one of the reasons why it came across my desk in the first place. And then looking at the fundamentals, the company said at their recent results that the results were in line, but they could reflect the bottom of the earnings cycle. So we've got a cost out program that the company is doing. They were 2% ahead of expectations in FY21, and they've increased that by about 10% and extended it out for another 3 years into FY24. But the big moving part is the rising interest rates, or expected rising interest rates in the UK and the US. And that, of course, would boost the margin income for CPU and make their returns much more attractive. Also, generally a positive for their mortgage servicing business as well. They see decreased refinancing activity, I should say, and increased foreclosure opportunities as interest rates go up. So if that plays out, that is the expectation. Of course, globally, that interest rates will rise, and that will help, of course, the CPU business.